thank you for taking the time here on this. I know you're a busy guy, so we'll go ahead and get this going here. Um, so your background here, you've worked across a pretty wide range of asset classes, and I also see that you have a rugby background too.
Yeah, I
12
do.
years rugby, that is no joke, man. So
Yeah.
12 years. Okay. Uh, there you go. Well, you're tough enough to do that, man.
Oh, thank you. I appreciate it. Yeah, it's a great sport. I'm American, but it's people always I've had the pleasure of meeting people from all over the world, and they're always surprised that I've never played basketball, football, baseball, or even soccer or football. In respect to the international community,
Yep.
but yeah, it's always been rugby. It's just the
Yeah.
way things played out for me.
Nice, nice. Wow. Hey, there you go, man. Good for you. So you've advised on over $1.5 billion in transactions. That is a lot of work, a lot of achievement in your field through many different market cycles too, right?
Yeah, I would say so. Yeah, my the number's grown quite a bit. I mean, we're kind of wrapping up January now, or midway through at least. But no, I mean that number has grown. We've advised slash supported transactions. We've almost doubled that number at this point just in the last 2 quarters. So
Wow.
it's businesses really had an uptick. And we see that across asset classes. Really, from multifamily, you name it,
Mhm.
that's pretty much what I feel most people or most advisors are going to have some exposure to multifamily, but definitely in asset classes that historically haven't gotten as much attention, which self-storage comes to mind. Data
Yeah.
centers, while I don't particularly cover that asset class much at all, you still do hear that naturally more and more in conversations these days. So.
Nice, nice. All right. You've got a lot of experience in many different areas here. So, Christian, uh, when you think about underwriting and capital stacks, what are you seeing in the market right now? What's going on with the market right now with that?
Yeah, I think right now capital has historically been tight. So I'll share I'll give you 30 seconds about Reina Property Group. We essentially
Sure.
work as a fractional deal team, and that's not meant to just be underwriting or pitch book creation. We don't want to be a deliverable focused entity. We instead really, and I know many firms
Mhm.
say this, but we really strive to create value. So whereas you may come with a deal that you believe is a home run, we'll instantly begin poking holes to it. So poking
Yeah.
holes in it rather. So again, in many cases, we've partnered with family offices, with brokerages, with investment banks, with private equity funds, and really our bread and butter has been emerging institutional entities, and
Okay.
we've driven meaningful value. So we'll really, as you mentioned, go through
Yeah.
their underwriting and poke holes in their underwriting. For example, you're underwriting a 4% or 5% rent or year-over-year rent growth, and prevailing markets data, the sentiment in general is saying, well, that's 3%. So when you're looking to raise on the capital stack side of things now, when you're looking to raise money, the first thing that a family office or any institutional investor is going to do is one, they're of the mindset of capital preservation, where
Mm.
sponsors are looking largely for upside. So what we're doing is really making sure that one thing, we're not being overzealous. It's very easy to put the cart in front of the horse as it goes, but largely, yeah, I think with in terms of underwriting it should always be famously in investment banking, we're told it's an art and a science, but I do think from the science side, it's pretty tried and true. Don't be overzealous to the market. I think a great exercise is untrended versus trended. I think that's always a great analysis to include. And then capital
Mhm.
stack side of things. Um, Obviously, we understand the effects of positive leverage, but you can easily be over levered too much. So in any analysis that I do, any underwriting, you're always going to see if there's a refinance involved, we're going to size the loan as accurately as possible. Namely, we're going to look at the DSCR stipulations, the LTV stipulations, and the debt yield stipulations, because we don't want one, we don't want to expend too much of our bandwidth on deals that won't actually make the finish line.
Yeah.
And then second,
Hmm.
we also, when sponsors are engaging us, again, we're not just deliverable focused. We truly are meant to be a partner and give you that investment banking, that institutional private equity background, and allowing emerging sponsors to have that same output.
Wow, nice, nice. So, Christian, you describe RPG as a fractional deal team.
Correct.
What problem does that solve in today's market?
Yes, great question. So, the problem that it solves is somebody with my background, which is includes investment banking, and I chose an entrepreneurial route pretty early on into my career, so that's pretty unorthodox, where most people will do 2 years as an analyst, maybe another 2 years at a real estate private equity fund, maybe VC, and then go and do their own thing, maybe B school somewhere in the mix. Whereas I chose to go the entrepreneurial route for several reasons pretty early on into my career. But the problem that it solves, and it's a pretty tangible one, is that people have access to deals, but people
Mhm.
don't always have access to the best talent, and the best talent does cost. If you were looking for somebody with, again, that background that I described, investment banking,
Mhm.
private equity, the
Yeah.
total compensation at market rate, not even somebody who's a quote unquote breadwinner, is going to reach numbers in excess of 300 to 400,000 per year, and that's somebody who's going to be a mid-level professional. What RPG, Rainer Property Group, what we do is we allow people to have that same institutional output at a fraction of the cost. And the way that we do that is by offering it on a fractional basis, meaning if you're only looking to do 2 to 3 deals a year, there's no need to have someone that costs you 500,000 a year once you take into account fringe benefits,
Hmm.
and that sort of thing. Instead, you can engage us. And what many sponsors have loved is, hey, you know what? Like RPG, if we only need you guys for 10 hours a week, we're able to do that. And they have gotten there has been no decline in the output that they would expect. We grow alongside our firms. It's not like we offer just a single solution. Our models will look different across client bases. Obviously, a family office is going to have more of an emphasis on capital preservation than a sponsor who's looking to do 5 to 6 developments a year. So we're nimble. We're able to plug into the economics of our client base, and really the feedback has been overwhelmingly positive.
Fantastic. All right. So, at what point do clients usually bring you in? Early concept, capital raise, or execution here?
I would say more often than not, it's going to be at the so it's largely going to be based on capital raising, but usually the typical profile of our sponsors are, and we do have some anomalies where you have established banks, 30 plus years regional banks who engage us, but there's also um it's largely when you have a sponsor that has a defined track record, maybe a mom and pop sponsor where 5 to 6 years of sizable returns, and they're looking to get more of move into that institutional space for a number of reasons. One, a lot of the times they just don't want to exhaust friend or they have exhausted their friends and family network and they want to pursue larger deals, so they need larger check sizes. So instead of having 20 or 30 LPs, they're looking to have institutional partners that maybe four or five that will write those equity checks that they need to get deals done. So more often than not, we are we're engaged by usually those sponsors that have a measurable and also formidable track record, and are looking to get to that next level, perhaps middle market, and typically they're in the lower middle market range.
Got it. Okay. Right. So, you started in investment banking and private equity before launching your own firm.
Yes.
So, yeah. So, how did some of that institutional training shape the way you approach deals today?
Yeah, I think with investment banking in particular, there's really no room for mistakes.
Yeah.
It's just I think the culture is very much pride, and I don't say this in a negative light, but prides itself on perfectionism. So you can't just be a one-trick pony. Some people are really good at analysis, but don't understand narrative. Or some people may be good technically, meaning in Excel or PowerPoint, but don't know how to have a client facing, or don't, again, don't know how to communicate a message. Whereas investment banking, those issues, any holes in your skill set are quickly exposed, and the culture in investment banking is particularly honest. I will
Yeah.
say, make of that what you will. So the weaknesses are thrown out pretty quickly. I mean, I equate it.
Mm,
Um, it's just my rugby background, same thing. I think there's many things that
mm,
many things in my history that have kind of made Reina Property Group what it is. But again, with investment banking in particular, just thinking in financial markets and in advisory services, yeah, investment banking, you learn to do everything. I mean, you don't just learn
mm,
about the asset class, you're going to learn about capital markets in great detail. So
Nice. And you tie that back to rugby, right? Oh, okay.
yeah.
Yeah, a tough sport. So, you so what did working on distressed debt in New York teach you about downside risk, Christian? How did that go for you?
Yeah,
Working on distressed debt.
great question. I mean,
Mm,
one, a lot of equity sponsors doing their underwriting or advising on deals with them, debt is kind of an afterthought. And even with capital raising, a lot of the engagements that we get are going to be based on raising equity, because debt is, as a friend of mine said, kinds of finds its way into the deal on its own. Um, but generally speaking, in terms of distressed debt. I mean, you see
yeah,
it. You see the sides
yeah.
of when you don't take that approach and are reasonable about leveraging on your deals and
Hmm.
making sure your capital stack is optimized. Yeah, you see the results of that because with that firm that I was working with, the whole idea was to acquire non-performing loans, and then we would sue at the up to 24%, which is subject to usury law. So that was really the ceiling. And yeah, and so you would find waste wherever is a monetary or technical default and retroactively charge interest on that. And then that's where the money was made. But generally speaking, yeah, you see the other side of, okay, like this underwriting, when an underwriting went too far and an investment strategy went too far, and debt was what you underwrote ended up not being reality and too far, and then your debt is sold, you get a hello letter, and now you're in trouble. So generally, I think that has allowed me to intimately understand, as the person who
Hmm.
was drafting up hello letters and looking
Yeah.
back in
Hmm.
debt service schedules and seeing where monetary or technical defaults were happening. You quickly learn to understand, yeah, let's not take on too much leverage. Sometimes it's better to cap out at 65% LTV,
Hmm.
even though a lender is quoting you up to 80 and maybe another
Yeah.
10 with mezzanine. So
Right. Okay, good. So, how did your time at Deutsche Bank change how you think about capital markets?
yeah, good
Okay.
question. I think again, exposure to everything. You
Hmm.
learn, and that's why I'm very appreciative of my foundation in investment banking. You
Hmm.
learn very quickly about all these different levers that you can pull with debt. It's so much more than just LTV or LTC. You can pick or capitalize interest in different things of that nature. If you need one transaction that we were engaged on, and I'll be sparing with the details, but or discuss the details sparingly. But we had it was looking to raise around, we'll call it roughly $100 million in debt, and so obviously we needed to go to some alternative forms of financing, which included family offices, and not to mention this was an overseas transaction. But investment banking exposes you to that. It's more than just going to your local bank and asking for a loan. You really learn to look at your different avenues for getting financing, because again, with investment banking, particularly at the bank that I was at, you're dealing with larger transactions, and some of these headline transactions you'll see in the Wall Street Journal, whatever it may be. And so once you're dealing with transactions of that size, you're dealing with you're dealing with syndicates or whatever bank is left lead, and you just understand how you get these Goliath size deals
Mhm.
done. And so you definitely learn how to be creative. So from a capital market standpoint, separate from just the general wisdom of not over leveraging, yeah,
Mhm.
you learn how to get deals done and think in ways that are perhaps unorthodox.
Nice. Okay, very good. Uh, so you've underwritten deals across multifamily, hospitality, self-storage, and mixed use. What separates a deal that looks good on paper from one that actually survives scrutiny?
Yeah. One, I think first and foremost, the deal that looks good on paper um
Mhm.
is the deal that takes real market data into consideration. And so what I mean by that is, for example, if you have access to CoStar, use it. And if you don't, look at the larger brokers that are putting out information. Look at precedent transactions. You really need to understand, and honestly, visiting the asset, I think helps as well. I think some of the best performing sponsors, and again, you have financial sponsors that are really just concerned with dollars and dollars out, and then some take more of an owner operator approach.
Mhm.
But overall, there's yeah, it's a matter of, again, I think not being
Mhm.
overzealous in your assumptions. Like Miami, for example, a few years ago, when I founded Reina Property Group, I mean, rent growth was in, I guess, quote me on this, but I don't have the exact number, but I do think it was seeing double digit rent growth. And so
Mhm.
when I was in Miami, particularly the Brickell area a few months ago, you see kind of the results of that, and you have pretty much all product there is
Mhm.
luxury or ultra luxury. You have these condominiums going up, and so those deals are surviving. But I have my own outlook with the condominium market in Miami. But overall, I do think it's just you really have to understand the market data because that's ultimately what's going to decide how the
Yeah.
investment performs. You could be the
Mhm.
best developer, you could have the best GC, you could have
Mhm.
the best leverage, the best financing, but reality, it's supply and demand. Our house absorption.
Yeah.
Um,
Yeah.
and I remember in New York in COVID, concessions, and I vividly remember this because I was apartment hunting, were as much as 4 months free,
Yeah.
kind of at the height of COVID. So you definitely see, you have to understand market dynamics. That is the number one thing.
First and foremost. Very, very good. Very good. So where do sponsors most often get underwriting wrong? Where do
Okay.
sponsors get it wrong as far as underwriting?
Hands down. Usually what you'll see, let's say development undercapitalized. Always undercapitalized. Sources and uses table. A
Mm.
mentor of mine slash client as well, does a very deep analysis into sources and uses and even going as far as calling the assessor's office and intimately understanding exactly how property taxes are reassessed in the context of value add or opportunistic deals. I mean, a lot of times sponsors just overlook that and it'll just be an assumption in the model and like taxes growing 3 to 6% per year. And then
Mm.
in reality, you have this giant tax bill or and that's in the negative light, but then there's also understanding what abatements do you have available to you. Like one sponsor that we worked with, they're operating in the Sunbelt region, and they were able to save, and I don't mean this, and this isn't hyperbole, Bill,
Yeah.
$90,000 per year because they found out that they can get an abatement by partnering with a nonprofit organization, and so now their NOI is effectively increased 90,000 per year due to an abatement.
Mm.
So I think a lot of the time sponsors,
Mm.
I don't think you need to fall into the realms of analysis paralysis and have a
Mhm.
47-page model, but I do think, especially if you are raising outside capital, and that's again, Random Property Group is intended to be client centric. I don't care if a sponsor is deploying 5 million a year or 500 million a year. Beyond
Mhm.
that LP is whatever LPs are involved in that deal or GP, they're investing very real capital into that deal. So whether you're a Steve Schwartzman or a Sam Zell, whatever it may be, or you're a quote unquote mom and pop sponsor, people are concerned with capital preservation. And arguably
Mm.
those who only have $50,000 checks to write probably care about it more than the people who are able to write $5 million checks at a time. So
Mhm.
so really, sponsors where they get it wrong is undercapitalized or overzealous about their assumptions.
Mhm.
Absorption is a huge thing. A lot of times people miss the mark
Yeah.
with refinance timing. You think the property is going to be stabilized in 3 years, and now all of a sudden, if they've got a bridge loan and it's 3 + 1 + 1, you're in that extension option, and you've extended again, and all of a sudden, things don't pencil out the way they do, and then that's when you end up on the other side of a hello letter from a distressed note purchaser. So.
Yeah. Yeah. Very, very, very good. So, how do you think about feasibility versus optimism in pro formas? What's your take on that?
Yeah,
Eh, Pro formas. Yeah.
again, I think when you intimately, and if you look at a lot of the content that I post on LinkedIn and just YouTube, wherever, it's I post a lot about waterfalls and profit distribution structures.
Yeah.
Um, and the reason why I do that is because that's so important. Like at the end of the day, I always tell people whether I'm training somebody who's looking to break into Wall Street or even just advising sponsors on deals, it ultimately comes down to money in cover and money out. We're
Yeah.
looking at levered cash flows and how does that get distributed.
Mm.
Now, in terms of optimism and feasibility,
Yeah.
what you've asked is, well, generally speaking, GP, because of waterfalls, their IRR is going to be significantly higher, especially if they're charging an asset management fee, an acquisition fee, a financing fee, a
Yeah.
disposition fee. So they're really in their mind, and it makes sense. Like, can I always tell people candidly, yes, we're in providing financial services, but people want to earn a living, and this is an industry where you can earn a sizable living. I don't hide that. But all more often than not, people get caught up in we can make X amount of money in this deal and less about capital preservation. So when in
Mm.
terms of feasibility, one of the most important pages you'll see in any marketing collateral that Rainer Property Group puts out on behalf of its sponsors is risk and mitigants. Family offices and these players that want to deploy capital into deals, they would much rather just hit their preferred return as opposed
Yeah.
to losing 25% of their initial contribution, right?
Hmm.
It's capital preservation first and foremost. So when it
All the
comes
way.
to Yep. So when it comes to feasibility and optimism, kind of pump the brakes with the sponsors and say, hold on, like let's
Mm.
backtrack and let's see where the holes are in the deal. Generally
Yeah.
speaking, again, when I'm at the gate of, because sometimes what we do is for family offices, we'll actually screen any investments that come in. The first thing that I'm going to do is I don't look at why the investment works. I'm going to look at how it doesn't work.
Yeah. Yeah.
And family offices and whoever we're screening deals on behalf of always appreciate that because the
Mm.
number one thing is capital preservation. That is the
Yeah.
first part of any waterfall.
Yeah.
Is
Yeah.
cap is return of capital.
Got it. Got it. So, a lot of sponsors struggle with the capital stack design. How do you think about balancing debt constraints, preferred equity, and sponsor economics?
Yeah, great question. I think yeah, that's unfortunately one that people miss, and I'm glad you mentioned preferred equity because whenever I see that, it kind of raises a red flag. Not to say that that doesn't have a place in the capital stack, but usually people don't. A lot of sponsors, when they're looking to raise capital, they don't really have a sound reason for including preferred equity, a strategic reason other than they just want to reduce the amount of capital they're putting into the deal.
Hmm.
And so I don't think that's reason enough to go in and look at preferred or mezzanine or getting too creative with the capital stack. But generally speaking, in terms of optimizing the capital stack structure, again, I think first and foremost, I think everybody kind of learns this day one finance is let's take multifamily as an asset class. We probably don't want to go above 80% LTV in our initial underwriting. And if we
Hmm.
do need to go above that, whether it's preferred equity, mezzanine financing, you want to make sure that you have a very compelling reason to do so because sponsors, again, it's very simple. When you're looking to raise equity, where does common equity sit? It's at the bottom of the capital stack. So all of these other tranches need to be paid first
First.
in the event of a rainy day before whoever those limited partners see their return of capital. So what we look to do realistically is say, hey, you know what? We're going to underwrite this deal. We pretty much do everything on a monthly basis and then aggregate annually because we like to have that level of granularity. But we want to make sure, okay, like is your debt service coverage ratio at least a 1.25x for multifamily? Is your debt
Mm,
yield at least 8%? And
yeah,
then of course there's their sensitivities as well. But yeah, what we're really into the business of doing is risk mitigation. I would say if you were to sum up everything, that is
yeah,
what will streamline capital raises. That is, which is already long enough in and of itself,
yeah,
but that's what I truly have observed is that's what people care about. Again, it's not about your deal is a 22% net IRR in three
yeah.
years. They'd much rather say we'll walk away with the 12% and we can count that and put that away as opposed to
Mm,
unfortunately we have additional capital calls coming out in the future because
yeah.
we materially misunderstood our underwriting or misrepresented our underwriting.
Safe rather than sorry on that. Yeah,
Exactly.
yeah. So where do deals usually break, fall apart here? At the LTV stage, the LTC, or cash flow?
Oh, great question. Another great.
Yeah.
It's a mix of them all because they all inform each other. But
Okay.
I mean, I always tell people I don't know when's the last time I underwrote a deal that didn't involve debt. So obviously
Mm,
the debt is going to be important. Usually, to be honest, the LTV isn't usually the issue. I feel like people more often than not understand that. Where people kind of always fall short is the DSCR stipulation
oh,
and the maintenance DSCR and then the debt yield. A lot of sponsors
okay.
don't even have that in their underwriting, and that's going to be an issue because when you are underwriting a refinance, no lender just says 80% of stabilized LTV. Yeah, that's part of it. That's one, but
Mm,
there's pretty much always in, at least in all the loan docs that I've looked through, DSCR and debt yield stipulation. So, yes,
mm,
from an asset basis, when you're loaning against asset basis, yeah, we're looking at LTV or LTC. But then from a cash flow standpoint, lenders are very much concerned about are you able to service that debt, hence the debt
mm,
service coverage ratio. So that's
yeah,
more often where deals fall through. A lot of the times, because again, once you take debt, that's setting a floor that your deal needs to perform,
yeah.
right? We're thinking break even occupancy. So
Hmm.
the more
Hmm.
debt you have is the higher that occupancy needs to be. And
Yep.
if you, for example, were very bullish on a market in South Florida, let's say Tampa, for example, and then you underwrote 7%, yeah, you may have been okay if it ended up being just 4% growth, but now you've taken on too much leverage because you completely ignored, or your deal ignored the debt service coverage ratio and the debt service, debt service coverage ratio and debt yield, stipulations. Now it doesn't work and you're in default, right? So,
Right. Right.
so yeah.
Yeah. Okay. So again, a bit of a side question on this, but so how do you structure your waterfalls so that they hold up under lender or investor pressure? Kind of more what you've been talking about, but how do you structure those waterfalls so they hold up under this pressure?
Yes, so no waterfall should be I don't th I think yes. I think it's fine to most models will have a default waterfall,
Yeah.
but these are going to change. One of the things that we get engaged on the most is or just at least asked about is Christian, how does my profit distribution structure look? Does this make sense? And is this going to be palatable to external stakeholders? And
Yeah.
more often than not, the waterfalls are overly simplified or overly complex. So one
Hmm.
of the things I've recently posted on is really you have to know your audience, and I think that's with anything. I really do believe that's with anything because if you're looking to raise institutional capital, and again, most of our client profiles typically those lower middle market firms moving into middle market and want to raise institutional capital, a pari passu return of capital plus preferred return doesn't cut it because if you're looking to raise money from a pension fund, which is arguably going to be the most conservative institutional lender out there,
Hmm.
you can't say that you're going to return capital pari passu, really, or at least you could, but it's going to materially delay your capital raise. What you should do is you need to do 100. What I typically do is start with 100% return of capital to the LPs, and then we
Yep.
have a GP catch-up provision. When you're dealing with mom and pop investors, then fine. You know what? Or just really friends and family, I should say. Then fine, pari passu is fine, and you have maybe one tier. And then you have your return of capital, preferred return, and then residual cash flow split with promote in there. But as you move up the institutional scale, sometimes, you know what, we'll even bake in a multiple and IRR based hybrid schedule. So,
Right.
again, sponsors are very much focused on how much money can I make. And you see that with very fee heavy
Yeah.
sponsors. But
Yeah.
then the LPs are directly against that. They're looking for capital preservation and they want to safeguard their investment as much as possible. So, it's always going to be the differences with waterfalls is going to change dramatically, depending on the sponsor, who the prospective
Mm.
stakeholders are, and yeah,
Yeah.
we always adjust.
Got it. Right. Oh. So Christian, you often talk about investor-ready narratives.
Yeah,
So what does that actually mean in practice for you?
yeah. Investor ready narratives, and
Yeah,
I'm sorry, Bill, if you get tired of hearing me say this, but capital
that's okay.
preservation,
Yeah.
Cap-
Let's say it again.
capital,
It's
yeah,
important. It's critical in your
capital.
business.
100%. It's capital preservation. It's
Mm.
understanding capital preservation and risk and mitigants. Everybody has the best deal. Everybody's the new best sponsor.
Mhm.
Everybody's found an opportunity in the marketplace. But reality of the situation is, in terms of investor narrative, you really have to think. It's quite simple. I see capital raising as if I were to walk down Fifth Avenue in Manhattan and I'm literally asking people, I want $100,000 for my investment. What do you think that person's going to say to me? Why would I do? Who are you? Why would I do that? So first,
Mm.
establish who you are. One of the most important things in terms of investor ready narrative is your track record. No,
Mm.
people need to know exactly what you've done and why you were qualified, why you are a sound fiduciary to literally help dictate how their retirement's going to look. For
Mm.
those who are interested in alternative asset classes. So there's that. There's also, again, risk and mitigants, capital preservation before you try to,
Mm.
sell someone on a 2.5x multiple and on a 3-year deal. And then again, it's
Yeah.
investor readiness is really, you have to look from the perspective, and this is where I feel like most underwritings fall short. You need to look at the perspective of the limited partner as opposed to the general partner. It's very easy
Right.
internally. Fine, if you've got your vision board and you've got your vacation homes on there,
Mm.
and what you want to
Yeah.
do once you consider all the fees you're collecting and your post promote returns, fine. But generally speaking, before you get there, the limited partners and any external stakeholders, lenders included, because I do
Yeah.
include those as external stakeholders, they want
Sure.
to make sure that they're getting their debt service in the case of lenders, and that the LPs are, if the market has a correction, which I define as 20%, I do believe that's the generally accepted definition of a market correction, then yeah, you want to make sure that your deal holds up, and what are
Yeah.
your safeguards against that if it doesn't. So
Hmm.
that's
Hmm.
really, yeah,
Right.
that's my approach.
So, following up on that, so what questions, say, would a credit committee ask a sponsor that maybe the sponsor does not anticipate?
Yeah.
Mm.
Um, so one thing, and I understand this intimately,
Mm.
the questions that they're going to ask is, once you submit that, and remember, I'm also the person doing this, so this isn't hypothetical.
Yeah.
Once I get an underwriting from a sponsor, I'm essentially going to throw it out the window, because more often than not, sponsors are very overzealous. And then we'll go and do our own underwriting. It doesn't
Yeah.
matter whether you are the bank on Wall Street that's collecting the most fees. If you're a major bulge bracket
Hmm.
bank, it once your underwriting or whatever you've done hits the desk of a sponsor or whatever it may be, and whatever the counterparty is, they usually going to throw out your underwriting entirely. They'll look at it as a baseline, but they're going to do their own underwriting again because they're concerned with capital preservation, not lining your pockets with fees and promote. So there's that. But what questions that a credit committee would ask, in particular, is going to be, how did
Mm.
you get to this? Again, I'm just going to focus on multifamily as our baseline asset class. How did you get to these in place rents? What made you think that, oh, okay, let's say it's a value add deal or ground up construction, that these would be the in place market rents? How are you arriving at that? What data justifies that? And again, the answer is you go to CoStar and you see, and then often than not, okay, you've underwritten, what the gross market rents should be, but we're seeing that concessions in the market are in excess of 10%. Why don't we see that in your underwriting? So the credit committee questions, they can, yes,
Mm,
despite the name credit, remember it's all cash in, cash out, and it's going to start at the asset level first, the asset level cash flows, and then you hit the debt service. In terms of debt service questions, again, number one thing you're seeing is, why did you not look at
yeah,
the debt service coverage ratio?
yeah,
Why did you not look at debt yield? Why are you over levered? And then, especially, I think sponsors really shoot themselves in the foot here is when you include preferred equity. Like it's like, is your capital stack too beefed up to the point that the deal doesn't pencil out anymore? And again, there's a balance to be had. I think if
yeah.
a good deal is going to be made better with leverage, and a bad deal is going to be made worse. Many
Okay.
people just
Hmm.
kind of, and you see this on TikTok or wherever it may be, but debt is like, yeah, debt is always spun as this positive thing, and it should be. And when things are aligned perfectly, but it can also hurt you,
Yeah.
very much so. So, and credit committees, of course, understand that best. And then,
Yeah.
yeah, and then a
Good.
lot of the times
Good.
beyond that, beyond the questions is what provisions are they including, whether it's a bad boy carve out, whatever it may be. There's these other protections that they put in place that they ask sponsors, have you considered this?
Okay. Okay. I'm going to move ahead for a little bit here to some future focus questions here. Christian, this is quite an education here. You explain so many valuable things succinctly and do it in such a great way for people to understand. So, but my
Thanks,
future
bro.
focus, you're welcome. Yeah. Given everything you're seeing right now out there in the marketplace, what should sponsors and investors be paying closer attention to over the next 12 to 24 months?
Yeah, I think I think I could maybe give twofold answers. One, I think with those who are operating in a already operating in markets that are strong, um, let's not assume that they're always going to be strong. I
Mm,
think I think
yeah.
that's a I think that's a mistake. So I mentioned earlier in the call, Bill, with Miami, for example,
Hmm.
being down there. If you really go, because there's a lot of luxury high rises, if you go to the top of any of these buildings, and I laugh, but I think people in Miami and
Hmm.
South Florida in general will understand this. Count how many cranes you'll see from your eye view. There is a lot of product, particularly condominiums, being delivered to market. I
Mm,
am of the
mm,
opinion, my family is from Latin America, and many of the purchasers of those assets there are purchasing pied à terre, which French is like foot on the ground.
mm,
But these are international buyers looking to buy apartments in South Florida, for the example. In New York, we're a little bit more Asia, Middle East, and you see this in Central Park South, many of those ultra luxury developments. But overall, particularly in Miami, in the Brickell area, you're seeing oversupply. And I believe that many of these underwritings, many of these developers that are putting up these assets, a lot of them are going to be, some of them are going to be caught on their heels because
okay.
it just seems that there's too much development going forward. And again, when COVID happened, I feel like at least from my personal experiences, that's when Miami at least became popular on my radar because it seems like net migration. And again, the statistic, I don't remember the exact statistics, but I'm sure they had positive net migration that was considerably higher than most other places in the
Mm,
country, and so
right.
rent growth was higher. The basic
Yeah.
macroeconomic factors that drive rent growth,
Yeah.
and but that doesn't mean you underwrite that forever. You don't underwrite that in perpetuity. Another thing you would see in all of our underwritings is we don't just slap on a growth rate for years 1 through 10. That can change. Year three, it may be 8%, or year one, it may be 8%, year two, it may be 8%, and then it may taper off, which is what you most often observe in markets. Things do
Yeah.
hit a steady state growth. Um,
Yeah.
but overall, I think what sponsors should do, even if they've gotten into a market like Chicago is incredibly strong right now, that doesn't mean you underwrite 10% rent growth in perpetuity, because I do think they saw double-digit rent growth this year or in 2025. So I believe that's what sponsors should be looking forward to. And then from a capital raising standpoint, again, I don't think whether we're in whether the
Mm.
market is being pulled back or it's being catapulted forward, is capital preservation and
Yeah.
understanding. I can't think of any LP base or any institutional investor that doesn't prioritize capital preservation. And
Yeah.
sponsors need to intimately understand that and say, you
Hmm.
know what, like some sponsors will very much have a GC hat on and they want to get boots on the ground and build up. But every single building pretty much that you see started off in a spreadsheet, for better or worse, and
Yeah.
started off with a deck. And so that's where the meaningful conversations start. Things could be
Right.
back of the napkin, but again, where you if there's too many shortcuts put, it usually it doesn't get the
Yeah.
finish line and it ends up materially hurting the sponsor.
Got it. Right. So, if you could give one piece of advice to an emerging sponsor trying to raise capital today, what would it be? One piece of advice.
One piece of advice. Be be LP centric. And
Hmm.
because when you are LP centric, don't think about yourself, think about the LPs. And that's a lesson I learned with Reina Property Group is being client centric. They very much appreciate that if they're in a fire drill and it's 2 a.m., that they will get an email back from me by 2:10 a.m. And that's not hyperbole. It happens all the time. And in fact, when I take longer than an hour to respond, people think that something happened to me. It's truly to that degree.
Whoa.
Um, and I think again,
Mm.
we're in financial services and we're playing with very real dollars. And
Yeah.
so by being LP centric, whether that's giving a call and giving an update, not letting too much time go by without corresponding with your LPs, or just taking additional time in your correspondence to say this is what we've done, this is what we're looking to do, and our outlook, and this is how we're preserving your capital. That goes a long way. And
Mm.
again, LP centricity is that's going to inform your underwriting because if you're really concerned about preserving the investments of your stakeholders, then you're not going to be overzealous in your rent growth assumptions, or you're not going to materially reduce vacancy for your asset when market vacancy may be
Hmm.
10% and you're saying it's 3% for your asset. So I think that trickles through everything. LP centricity just goes a long way, and even outside of real estate, Amazon, right? It's very simple. They realized people got tired of waiting for shipping, and now
Yeah.
the market generally is expects next day or even overnight shipping, next day, overnight, or prime 2 days shipping. At least
Yeah.
my consumer habits have definitely changed. I
Yeah.
remember I'm young, but yes, I remember back in the day, you typically waited 5 to 6 days, sometimes,
Yeah.
5 business days to get your package. Now, to anything beyond 2 days, it's like, what's going on? What's with this company's
Yeah.
logistics pipe? Like, it's
Yeah.
just not there. So, again, being LP centric, being client, whatever your client base is, put their needs first, and I think everything else falls in line.
Wonderful here. Christian, thank you so much here. This has been an extremely thoughtful conversation. You are so well spoken and taking complex ideas and concepts and presenting them where people can easily get them at whatever level of commercial real estate they're at. And I especially appreciate how practical and grounded your perspective is here. Thank you, sir. Yeah.
And thanks for having me, Bill. I appreciate it.
Yeah, you're welcome.